Hello, welcome to this lesson on GDP. GDP measures the production of all final goods and services in a country within a year. It matters where something is produced, where it's made, not where it's sold to be counted in GDP. To calculate GDP, we have two methods. We have nominal GDP, which uses current prices. So that's going to be the current year price times the current year quantity. And then we have real GDP, which adjusts for inflation, for changes in prices over time. And for that, we use a base year price times the current year quantity. And we'll tell you what the base year is. Here we have an example, and you see it says the base year is year A. So here we have year A and year B. And in this economy, we're only producing cars and toys. So year A, this is the amount of cars that they produced and how much each one was valued at. So let's calculate nominal and real GDP. So for year A, nominal GDP, we're going to use the current year price times the current year quantity. So let's do it. 2, which is the current year quantity, times 1,000, which is the current year price, plus for toys, 10, which is the current year quantity, times $10, which is the current year price. And that gives us a year A nominal GDP of $2,100. Let's do year 2. So for year 2, we're going to use the current year quantity, which is 3, times the current year price in year B, which is 2,000. Then let's do the same thing for toys. The current year quantity, which is 15, times the current year price in year B, which is 20. That gives us a year B nominal GDP of $6,300. Now let's do real GDP. Now remember, real GDP is the base year price, which in this case is going to be year A. So we're going to make sure all the prices are the price from year A for each item. So for example, here we're not going to use 2,000, we're going to use the base year's price, which is 1,000. And then we multiply that by the current year quantity. So here we'd still use 3 because that's the current year, not 2. So let's do year A's real GDP. Well, since year A is the base year, nothing will really change for year A because we're using the same price times quantity. So the current year quantity, which is 2, times the base year quantity, which is 1,000, plus the toys, the current year quantity, plus or times the base year price, which is 10. That gives us a real GDP for year A of $2,100. Then for year B is where we have to be careful. So the current year quantity for cars is 3, times the base year price, which is going to be this $1,000 for cars, because year A is the base year, that's 1,000. Plus for toys, we have the current year quantity, which is 15, times the base year price for toys, which is year A's price, which is $10. And that's going to give us a real GDP for year B of $3,150. Now, real GDP is better to measure real changes in production because we're taking into account that change in price. Next, let's look at the different types of investment spending. So, capital investment is investment spending on tangible capital goods that lead to increased productivity. So, like new factories, new tools and equipment, new buildings, and new robots. This is going to be counted in GDP because it's producing something tangible. On the other hand, we have financial investment. Financial investment is investment spending on financial products. These lead to more wealth accumulation for the individual or business, but do not increase production necessarily. So examples would be like buying stocks in the stock market or buying bonds from the government or lending money to another company and charging them interest. Since they're not really changing production, this is not going to be counted in GDP. Now let's look at calculating GDP as a whole. So we have three different ways to do this. The first way is the expenditures approach, which adds up all of the spending in the economy. And these are the different groups that spend money in our economy. C stands for consumer spending, so you add up all the consumer spending. I stands up for all of the capital business investment spending. So it's investment spending, but only on capital. So do not count financial transactions in here. Then we have government spending. Again, with government spending, we're not counting financial transactions. They have to be producing something to be counted in GDP. And then we have XN, which is international trade, which is exports minus imports. So we add up all of the value of our exports to another country and then subtract spending on imports because that spending was not done on stuff that's produced in our country. So we can't really count that in our GDP. Remember, for it to be included in that category, it has to be spending on a new product. Cannot be used, has to be brand new, and cannot be just a financial transaction or financial investment. So you cannot just be transferring money around. Here we have some examples. We're going to see whether it's counted or not counted in GDP. So first we got spending $10 on movie tickets. Yes, that's going to be consumer spending, so that's going to be counted. We have spending $10 million on a factory building. Yes, because that's capital investment spending. And we have spending $5 million on a new Air Force jet. Yeah, that's going to be government spending, so that's going to be counted. Then we have spending $2 million on government welfare checks. Now, here, this is not going to be counted because they're just transferring money around. They're not really producing something new. Then we have spending $10,000 on stocks. That's a financial investment in the stock market in the McDonald's Corporation. And this is not going to be counted because that's buying a financial investment, not producing anything. Then we have spending $50,000 on cars that are made in another country. Well, that would not count towards our country's GDP. It is going to be factored in imports because we're going to subtract that over here. But that would not be counted for our country. It's just factored into the equation. Then we have spending $60,000, which is done by another country for US Steel. And that's going to be a yes because that's us exporting stuff to another country. So that would be counted. Another way to calculate GDP or a different approach is called the income approach, which looks at people's incomes and all the different incomes from different resources. So we have rent, which is income from land, plus wages, which is income from labor, plus interest, which is income from capital, plus profit, which is income from entrepreneurship. So here you have the different incomes generated from each, and we're going to basically just add them all up together to see the total value of incomes in that country. That's another way to calculate how much GDP a nation has. Because one person's spending is technically somebody else's income. And then we have the value added approach, which tracks the production process. This is the final way to calculate GDP. And it's the value of all final goods and services minus the value of all intermediate goods and services. So here we're looking at the value of everything, but then we're subtracting the intermediate stuff because they're already part of the whole. We do not want to double count them since the final good already says the value of its parts. So for example, if the final car is worth $1,000 and then the engine was worth 500, tires are worth 300, the final car would count, but we would subtract the intermediate products, which are the parts. That gives us a total value of $200. Another thing we have to look in GDP is to compare how it changes over time. So we use the percent change formula to do that. It's new number minus old number divided by old number times 100. So for example, if the new real GDP is 500, we're going to put that here as the new number minus the old number, which is 250, divided by the old number, which is 250, times 100 gives us a 100% increase in real GDP. Here's another example. If the new real GDP is 1,500, we plug that in here as the new number. The old one was 2,000, so we plug that in here and here as the old numbers. Times 100 gives us negative 25%. That means that GDP has decreased from the old year to the new year. That's all for this lesson. See you next lesson.